Welcome to the Retire Right podcast with Larry Heller. You deserve complete financial advice. There's no acceptable alternative if you want a plan to live well and on your terms. Complete financial advice equals complete peace of mind. Now, let's get into this week's podcast episode.
Hello and welcome to Retire Right with Larry Heller from Heller Wealth Management. Good afternoon, Larry. How are you?
I am terrific, Eric. How about yourself? Spring is in the air, I think, a little bit. Hopefully it's here to stay.
Yep. I spoke to one of my friends earlier, and he said the sign of spring is he's on the coast, and people are taking the wrap off their boat, which I'm assuming that's
there you go.
Yeah, we don't have that here in the Midwest too much, but I'm sure that you see that a few times a week as you're driving around. Larry, on this podcast, you really talk about planning a lot, and that is the kind of the focus of what you do, and you work with clients so well with that. But I know today we're talking about the stock market, correct?
Yeah, absolutely. Obviously, one of the big factors that we do is investment management, portfolio creation, and how to invest. So I thought today would be a great time to talk a little bit about the stock market.
All right, and you're the expert. So what do you think is going to happen in the stock market?
Great question, Eric. So that's probably the number one question that I get in a lot of different forms. What do you think is going to happen in the stock market this year or next week? And unfortunately, my answer sometimes is tongue in cheek. Well, it's going to go up, it's going to go down, or it's going to stay about the same. So many people are just so fixated on trying to figure out what's going to happen in the short term. And it's something they can't control, the stock market. But so many people want to, and they go on TV and they watch what's going on TV, and they see the experts on there saying, oh, the market's high, we should get out. Or, the market's overvalued, we should pare back. Or we should get out of this sector and switch over to this sector. And what I kind of say is, I really say it's hogwash. It's almost impossible to continuously get it right long term, when to get in, when to get out, which sector to move from, which sector to move out from. Sure, you want to make adjustments. You don't just want to leave it alone. But we can't control the market. This week, I've definitely read a few different articles out there that I found very interesting. Barron's came up with an article, The Undervalued Stocks for 2021, or Morningstar, 7 Surprising Stocks to Consider. And I guess maybe that people like that. They want to really think they could outperform, and they think by doing this, it's sexier, and people maybe think that's why they're coming to work with us. And I try to explain to them, yeah, we want to control the allocation and what you have in the stock market, but we don't want to try to time it. And there's so many studies out there that shows if you miss the best day or the best week out there. So it's just so hard to do that. The Wall Street Journal actually this week had an article that some 60% of U.S. large cap stock picking funds lagged behind the S&P 500 in 2020. And guess what? How many years in a row do you think that's happened, Derek?
Oh, what, past 5, 6 probably?
Yeah. 11 straight year of underperformance.
Jeez. Okay. Yeah.
So if the so-called experts that are running these funds that are actively trying to outperform the S&P and their benchmark can't do it consistently, how is the layperson out there going to do that? So you're much better off being able to control what you can control and not worrying about it. Two quick stories. So back in March, I remember having a conversation with somebody remember what happened in March, Eric? The beginning of this pandemic, and the stock market had a big downturn.
Oh, yeah.
Yeah. So our clients, we've been through these downturns before, and we've basically are positioned well to say, well, when it goes down, that's when we want to buy. When it goes up, that's when we want to take some of our profits. But I'm always intrigued by people that do just the opposite. And I was talking to somebody who basically said he couldn't take it anymore. And he literally, turns out, got out on the lowest day.
Oh, gee.
And I'm talking about over $1 million that they pulled out of the market. And we went on in the rest of 2020 to having a banner year, and he never got back into the market. So now he's looking to get back into the market, and he's coming and talking to us. So it's just interesting, the emotional impact of a down sort and how to do that. And I think this is more typical of what went on, is everybody thought with the election the market was going to go down, especially if the Democrats won. And then people said, well, and if they really control both houses, which they ended up doing with the tiebreaker, then it's really going to go down because the market doesn't like that. Well, November was one of the best months ever. I think it was the actual best November ever. And so people that had waited, and we definitely talked to a couple of people who they convinced they weren't timing the market, they were just waiting. Well, they missed the biggest month, the biggest November ever, and they're never going to make that back. You're never going to earn that back. So, and I can go on over the course of my career and how many different times out there that people have missed these opportunities. And sometimes there are going to be some corrections, and maybe you do get out, but then you got to figure out when to get back in so quickly. So trying to time this, and forget about the tax ramifications, but trying to time it and trying to, figure that out. My other tongue-in-cheek answer, so I have the one I told you before. The other one is I really go really low and I say, if I really knew, I wouldn't tell anybody. So because if I knew what to do, I would just make $1 gazillion and keep it to myself. Why would I be in this business? So, but all kidding aside, is nobody really knows. And we want to do things that we can control. So Eric, why don't you ask me, what can you control when it comes to investing?
Larry, what can you control when it comes to investing?
Oh, thanks for asking, Eric.
Hey, no problem. That's what I'm here for.
So let's go through some of them. I think I have 7 or 8 of them. So let's start with the first one, and that's asset allocation. And a while back, Brinson Biebauer did a study, and basically they studied the returns and said that 91% of your returns are based upon the asset allocation, not the security out there. And that's so true. I mean, if you're a growth fund stock manager, and you are the worst growth fund stock manager out there, you've done really well the last few years because growth stocks have been in favor. So that's been controlling that. If you are now in bonds and interest rates are so low, you're not making as much money. So your overall returns are based upon the forget about cash, it's making you nothing. But in 2008, if you were in cash, you made a lot more money by just staying in cash than if you were in the stock market. So you want to have the right allocation, and the right allocation that you're comfortable with within your risk tolerance, that's going to make you money over time, and stick to that asset allocation. We'll talk about some of the strategies you can do in the allocation, but you can control the allocation. We can control how much you have, not only in the stock market, but within the stock market, having some in large cap stocks, small cap stocks, growth stocks, value stocks, emerging markets. So you can create an allocation. And what we do is we create an allocation, and we've gone back in time historically and not only showed how having an asset allocation diversification has worked, but showing by having multiple asset classes, it really reduces your risk, because you're not trying to guess which asset class is going to be the winner. There are times where in one year, emerging markets may be the lowest performing allocation, but the next year it may be the best performing allocation. So trying to not guess which one and having all the allocations will reduce your risk and be able to provide a better rate of return.
Yeah, absolutely.
So, and then diversification. But beyond the asset allocation is the diversification. So many times we see people that have come to us with a few stocks, and sometimes they've made a lot of money in these few stocks because, yes, if you only have a few stocks and they happen to outperform, you're going to make much more money than you are in holding the entire market or the entire S&P. But on the flip side, you could also lose more money on that. So the more stocks you have, the better off you are. My staff just sent me a little chart that we're going to publish as part of our presentation, that over the last 5 years, that 30% of stocks have lost money. But I think there was 1,600 stock mutual funds out there. Eric, I'm putting you on the spot again. How many of those funds lost money over the last 5 years?
Out of the 1,600?
Yeah.
Oh, I'd say, 20% of them?
None.
Oh,
none.
Dang it, Larry.
So therefore, by having a diversified portfolio, there's less risk because of less chance of losing money.
All right.
Now, again, you can make more money by have gotten stocks that have done well, but you can also lose a lot more money. So you can control the diversification, and you can control how much you want in. And maybe you want to have a core strategy where you have your allocation into a lot of funds, and then you want to take a little bit of your money, a few percentage, and buy some individual stocks. So I'm not saying not to own any stocks. I'm just saying control the diversification. And then rebalancing. Buy low, sell high. We talked about before emotionally, just what you want to do, the opposite. Is that when the stock market is doing well, human nature is let's get in, and when the stock market is not doing, let's get out. And we want to create certain targets so you don't get overweighted in any particular area. So we have certain targets, and when they move by a certain percentage, we'll take some of the profits. We're not going to get it right exactly on the high, and the same thing when things are down, and when things have. It's not that they're bad out there. It's just that sector and that allocation is out of favor for now, and we want to buy some more in there. So you can control the rebalancing and how often you rebalance. For our clients, we look at it 4 times a year. We may not make any rebalancing moves, but we're looking at 4 times a year. For many people, once a year is fine, especially in their 401k plan. So rebalancing is you can control. Number 4 is the fund expenses and what you're investing in, and looking at some funds are going to do the same thing as other funds, but they're going to be higher expenses that you don't see that are buried in the cost. So controlling the fund expenses is something you can do.
How do you find that out?
So in any time of fund that you're investing in, you can either go online, or you can look at a summary in the fund family under expense ratio. I mean, it's buried in the prospectus. Most people aren't going to look at that, but you can go online and you can Google it and see what the fund expense ratio is. And there are ways of looking at what the average fund expense ratio is for that particular sector. So there are different ways of doing that. And we go over that. We kind of show our clients what they are compared to what the averages are.
Nice. And I'm assuming that you would help them then compare to other funds that would be similar, that would be less expensive.
Yes, especially when it's not as super active as some of these funds that are out there. So gotcha. Absolutely. So number 5 is taxes. So this is really interesting because it's not what you make, it's what you keep. So, and you don't want to have taxes kind of control your investment strategy, but you want to be able to figure out, okay, should I be investing in my qualified, my 401k, my Roth? Do I want to sell? And if I'm selling, do I want to, is it a long-term capital gain, a short-term capital gain? And are there ways of minimizing this through some stock identification strategies? Or when my income is lower and maybe I'm in a lower bracket for my capital gains. So controlling taxes is something you can to do. Again, you don't want it to justify that not doing something because you have to pay taxes. I tell people, hey, if we're taking a profit and you got to pay some taxes on it, that's actually a good thing.
Mm-hmm. Yeah, there's a profit.
Yep. And you can control, two things you can control is saving. How much you save. Compounding is a great thing. I tell my kids all the time that, just put something away. The compounding effect over your lifetime is great. So you can control the amount of saving that you're putting into this into the stock market. And then finally, time horizon investing. We'll kind of have a separate podcast about this, but when are you going to need the money? So you can control if you're saving up for a down payment on a house for next year, then you may want to invest differently than if you're saving for your retirement. So you can control how you invest in different goals in different types of goals and some time horizons.
Yeah, absolutely.
So those are things that you can control. So it's important to really focus in on what you can control and don't focus in on the ups and the downs that are going on each day, and some of the screaming that you may hear when there's a big drop. And we're having bigger drops because dollar-wise, as the market grows, the percentages may be the same, but the dollar amounts are going to be larger. So there's going to be differences, and we're finding that there are bigger increases and bigger drops more often than ever before. Yeah. So focus on what you can control.
I've got one more thing that you can control, Larry.
Great.
Ready?
Yep.
Your finger. Right. And I say that because I use my finger for my mouse or I use my finger for my phone, and avoiding clickbait, like those articles that you brought up earlier. When somebody's writing an article, they're trying to get a great headline. So people, I need to read this. I need to check this out. I think avoiding some of that media that is sensationalizing the ups and the downs is a great way to help us control what we do, because those types of articles are meant to elicit emotions. And you've talked about emotional decisions when it comes to investing before on previous podcasts. I think that's one other thing that we can control, is just being very wary of where we get our news, how we get our news, how much we're taking in, and then making sure we have somebody in our corner like yourself, a professional, that we can say, hey, look, I just happened to read this article or I saw this headline. What do you think about that? Because, Larry, I know that you're going to just tell them the straight truth.
No, absolutely. And it's not just your finger. It's actually what you're seeing on TV too.
True.
I've been on some of these TV shows, and sometimes they'll ask me about a specific stock, and I'm like, we don't really follow any specific stock or investing in specific stocks. But there are people that's what they do, and there are shows on there. It's sexy. People like that idea. They like to know, I've got this great winner in this big, this big stock, and they like, or so-and-so buddy told me a tip, a legal tip that you should get into this. So that's a lot sexier than, let's go into a index type fund and let's just hold it for 10 years and then rebalance.
That's right. Let
Not
me tell
so
you about
sexy on TV to talk about that.
That's right. Oh man.
But as we saw before, though, that the slow and steady kind of wins the game. Even Warren Buffett, he's the one that says for the younger people to invest in the S&P 500. So one of the greatest stock pickers of all time. But and again, if you look at him, he's had tremendous amount of losers as well as winners there too. So stay away. If that's another good suggestion, stay away from reading that or reacting to a lot of those things that are out there. And just because they're on TV doesn't mean they're an expert.
Exactly. All right. What else do we need to hear today on this podcast?
Yeah. So let's talk about looking at investing, and just remember, the stock market is really investing for the long time. It's not trying to guess the ups and the downs. Over the long time, the stock market has made significantly more money than any other asset allocation. So that's what you should be. That's what you should be in. But that's not going to mean in the short term that's going to happen. Now, we've had a great bull market. Is that bull market going to continue? Who knows? Well, maybe we eventually go into an extended bear market. But as we know, and as I've basically just told you, is you can't control the short term. So don't try to time the short term. Focus on what you can control, all the items that we've talked about. And again, like I said, there's plenty of room if you want to take a few percentage of your portfolio and buy the specific stock or buy a certain sector if you believe that you think this is going to be outperforming. We do that. We talk to clients about possible EV, electric vehicles and what's that's going to be, going forward. Or even we've had clients talk to us about cannabis. And so there's nothing wrong with doing and taking a little bit of your portfolio and trying to go for these home runs, as long as you understand the downside, and having the core in your diversified portfolio. Yeah. So why don't we just kind of summarize the steps that you can control. Is you can control, actually, once you look at your risk tolerance, you can control your asset allocation, you can control your time horizon portfolio and the investments that you need in each one of them. You can control your rebalancing. You can control looking at when you need to withdraw money and how much you should be saving money. You can control all of those. And not only just do you want to control all those, you also want to review. You want to review this. I talk to participants in 401k plans. And my first question is pre-pandemic. I say to them sometimes, how much time did you spend on planning for your trip this year? And they'll tell me, we online. I spent a couple weeks doing this. And I'll ask them, well, how much time did you kind of review your 401k allocations? And they'll tell me, I haven't looked at that in a few years.
Yeah, crickets.
So
that's all you hear.
So
is
you
crickets.
yes. So you don't want to just put it in and forget about it. You do want to review this. You do want to rebalance, and you do want to do what you can control. So you want to have a strategy. You want to have an investment strategy in place. You want to have a portfolio that works for you now. You want to control things that you can control, but you don't really. You don't want to focus or worry about what's going to happen in the stock market over the next few weeks, few months, even few years sometimes.
Yeah, absolutely. Great reminder, Larry, because again, I think during this time, people are looking in their own life, kind of doing some introspective searching and saying, what can I control? And this is exactly what we need to be thinking about.
Yeah, absolutely. You think it may be a little strange coming from an investment advisor, but that's basically, what we do out there.
Yeah.
And you don't need to be trying to outperform the markets to be successful.
Yeah, I don't know any one of my friends that doesn't want to have more control over their own finances. And that sounds silly to say, but I mean, we know that we subscribe to things sometimes and we forget about it, and all of a sudden, it's 7 months later and we've been paying for a monthly subscription to something we don't even use. That's the way that it works, and we just want more control of those finances. If we did that, then we'd feel better. And it makes even more sense when it comes to investing. So Larry, if somebody is looking to gain a little bit more control, right, and they want to know that they're doing the right thing, how do they get a hold of you?
So they can reach us. You go to our website, hellowealthmanagement.com, and there's a button there. You can actually click on that button and schedule a free 20-minute call with myself, or you can feel free to call the office at 631-293-2806.
Perfect. Larry, thank you so much for your time today. Always a pleasure.
This was fun, Eric, as usual.
Yep. And we want to thank you, the listening audience, for tuning in and listening to the Retire Right podcast with Larry Heller. If you have not subscribed to the podcast yet, please click the subscribe now button below. This way, when Larry comes out with a new podcast, it'll show up directly on your listening device. This makes it much easier to share these podcasts with your friends and family. Again, thanks for listening today. For everyone at Heller Wealth Management, this is Eric Johnson reminding you to live your best day every day. And we'll see you next time.